Welcome to your Mortgage Insider Update. It is April 28th, Monday, 26 days after the tariffs were released. Finally, some stability coming to the marketplace. We're going to take a look at the charts mainly today. Stability is what we're hoping for. There is a 90-day pause on many of the tariffs. Lots of deals being made according to the Trump administration. So we're going to check out and see what the markets are reading as we're in this pause period, which we have just over 60 days left. This week we're going to start off with a 10-year Treasury just below 4.25%, coming in 2 basis points lower today. Mortgage-backed securities are slightly higher, and those will work in inverse of each other, but we're going to focus today on the 10-year Treasury as it will tell us the tale of the last 30 days. So if you recall the beginning of last week, the 21st of April, we saw a little bit of a spike for most of the week before we hit that ceiling, that 100-day moving average, and then slowly came back down. Today pinched between the 25-day and the 200-day average, but we want to look back a little bit because that is actually the sweet spot we were in from the beginning of March. Before the tariffs were announced, we had a little move down in rates at the end of February, coming into March, and basically followed this 200-day line with some periods going up, some periods going down, but for the most part, other than back on March 27th, a little bit of a spike right prior to the tariffs and move back lower, only to be whipsawed. And this is what oftentimes happens when we see these giant moves, whether it be a lower move or sometimes even a higher move. We come back to the center, and that stability is what we're really hoping for to get home buyers out there more comfortable with interest rates that are not broaching anywhere near 7%, that are maybe even moving down week over week to 6.8, 6.7%. Now we are going to take a little bit of a step back. Let's go 6 months back and see where we stand today as opposed to the majority of the end of last year. So into the beginning of January, we actually saw our spikes. This 200-day average, you can see that over time, it does not move substantially. So even though we did see higher rates back at the beginning of January, the slow move back down, and even any of them move lower, to bring this curve down, which you can actually see the curve in the 25-day average has both dipped, and then now there's a convergence here where you've got the 50-day average, you've got the 25-day average, you've got the 100-day average acting as a ceiling on this most recent this last week in trading. We see hopefully the turnover to what could be a more substantial move if we can breach below the 200-day average. Right now, we're hoping for stability, but jobs report will come out this Friday, first week in May. First Friday in May, we'll get jobs, we'll get inflation reports this week, and this will be just before that next Federal Reserve meeting, May 6th through 7th. Just after this last PCE report will come out this week, and the jobs numbers on Friday. So this week we're going to watch that 10-year Treasury right around that 4.25. We want to keep it below 4.25%, or at least thereabouts, for some stability starting this week off as we get a lot of big numbers. Could be positive. A positive move lower on the 10-year, take us below that 200-day average, could put us in a much better position in the coming weeks as we hope to see that the deal making continues and that tariffs are released and relieved from many of these countries that will sign trade deals with the United States and bring more worldwide stability and hopefully lower interest rates. Have a great week.